Good afternoon, everyone. Thank you so much for joining us on the webinar today, 12th August. Very happy and excited today to have you all join us on this session. In fact, one of very significant moments for us in our history of our AMC. As I speak with yourselves, myself, Mohinder Singh, from Enam AMC, along with my colleague, Raghavendra Reddy, who's the portfolio manager for the Enam India Vision, portfolio that we have out here, that you have, in a capacity as an advisor as well as a family, have invested with us. Very, proud to state that we as an AMC have crossed $5 billion of AUM. As I speak with you all today, we express our gratitude and the support that you all have, entrusted with us. Without which we would not be where we are today. And as we come close to completing 27 years, as an AMC very shortly in the coming quarter, where we stand today, we are very excited about the journey that lies ahead as we go along, with our, the environment that we are operating under. In fact, the slide that you see across today is a synopsis of where we stand today, and very much has been pretty much consistent for us in terms of the factors of our representation of our franchise that we have today. We have kept it absolutely as focused and as consistent from our point of view, where we stand in terms of not only the size, but even in terms of our depth of the allocation, in terms of the 1/3 of the business that comes from the domestic part of the PMS, license that we operate, just crossed about 14,000 crores of AUM as I speak with you, with just over 1,500 clients, which thanks to the launch of Enam India Vision has crossed the 1,000 mark some time back, and today is actually inching up much higher as we speak across. We really are thankful to you all once again for do that. And while we've been crossing our milestones in a very calibrated manner, the investment team that we have, is very much, at the hem of it. A very large team which consists of 16 members out here. Our construct on the portfolio has stayed constant while we have evolved. We keep learning across as the markets do give you that opportunity to be there and learn and unlearn at the same time. We have kept our strategy very flexi, very core oriented in terms of our thought process when we look to construct the portfolios. And at the same time, given the levels that we have today, and irrespective of that, at Enam, for us, it's also about the way we manage the risk while we generate a very consistent period of returns. So Raghavendra, over to you. Thank you all once again, to join us on the call. Over to you, Raghavendra.
A very good afternoon to all of you, and welcome to our first webinar for the financial year ending March 25. So this is the first update for this financial year ending. We just are through with, out of the 20 companies in the portfolio, 18 companies have declared results. So there are some slides on the earnings growth and operating performance of our portfolio companies for this quarter. And we also have some slides on how the overall macro environment looks like. And as Mohinder mentioned, we finished 18 months into the journey of this portfolio and crossed about 800 crores of AUM. So also in this call, I believe we also have a lot of our friends from the advisor community. So a very warm welcome to our clients and also some of the friends from the advisor community who joined this call. So if you were to look at our macro part of our presentation, what we want to highlight is India on its aspirational GDP target of $10 trillion continues to gradually improve its ranking on the overall GDP of our economy. And the fiscal deficit number, which we see in this slide, which is about 4.9%, there has been an improvement versus the vote on account budget presented before the general elections. And we also believe that even for this 4.9% fiscal deficit number, there is a scope that government can deliver a better number given the uh, strength in revenues and also, the scope for spending on certain non-core areas to come down. Current account deficit has been very, very positive. We expect it to be below 1% deficit, but actually the number came in slightly better than our internal estimates and what we have been mentioning in our previous calls that, it could be less than 1% of GDP. So it's actually come better than that. External debt situation is comfortable. Forex reserves are at an all-time high at $675 billion around. The credit and deposit growth, credit growth is around 13.7%. Deposit growth continues to lag credit growth, which has been a matter of concern for the banking system as a overall sector. And if you also look at the bounce rate data, I think there is no reason for us to be concerned about the asset quality at a very macro level. But certain specific banks in our portfolio have mentioned that because of elections and because of extreme heat conditions, there has been some delay or some lag in the collection efficiencies in their system, and also some increase in the asset quality issues in terms of non-performing assets, because we were at a cyclical bottom in terms of where non-performing assets were. So it's a mild increase in NPS, but nothing alarming right now. If you look at our inflation and repo rate situation, in CPI inflation has gone up slightly during this quarter because of increase in the prices of food articles. Extreme summer conditions, there has been a fall in the production of certain food items like vegetables, and even the reservoir levels have been very, very low. So that has affected our food article prices, which has led to slightly higher inflation levels in the first quarter of financial year ending March 25. The rate change scenario has been same. I think RBI has continued to keep rates on hold for almost 1 year plus now, and we believe that they are also continuing to maintain the situation of withdrawal of accommodation as we speak. In terms of forex reserves, as I mentioned, we are at an all-time high. Improvement in CAD. In Q4, there is actually a current account surplus of 0.6% because of increase in GDP, increase in the services exports. FDI inflows have been lower in financial year ending March 24. Globally, I think FDI flows have been lower because of a tightness in the liquidity at a global level, increase in interest rates in developed markets. And I think there has also been some slowdown in global economy. So there has also been some repatriation of FDI investments in India. So that has also led to lower FDI inflows in FY24. GST collections continue to be good. Central government capex, as we mentioned in our previous interactions, has been very, very good. And this budget, government has committed 11.11 lakh crores of capex. So that continues to drive demand for a lot of industries and a lot of sectors. PMI manufacturing and PMI services, healthy levels of economic activity. Certain industries like construction, travel, tourism, certain parts of healthcare industries were affected by very, very intense heat conditions, and also general elections hampered, certain parts of the economy in Q1 F25. GDP growth continues to be in the 7% plus corridor in terms of where we are. And what we wanted to point out is, in fact, during the quarter ending June 25, there were severe water shortages in certain parts of the country that also leads to slowdown in construction activity. So that's what you see as a dip in PMI manufacturing or PMI services. So it trickles down to various parts of the economy. Inflows from domestic, mutual funds and the inflows to the SIP route continue to be very good. This data is widely publicized, and we believe that as long as earnings growth and the macro situation in our country is comfortable, the flows are likely to remain healthy. The only caveat is that we've seen some change in the interest rate policies of certain major global central banks. While Japan is increasing interest rates, countries like central banks like Bank of England, ECB, and US Federal Reserve is pointing towards possible cut in interest rates. So we believe that FI inflows are a function of global interest rates also. So we need to watch those factors while we monitor FI flows. In terms of monsoons, we were way behind the normal timeline schedule of monsoons in June, but July and August have been good. Toll collections have been healthy. CV sales in Q1 F25 were higher by 3%. Power consumption is one of the major positive factors when we look at overall economic activity. Q1 F25, our power demand in this country touched an all-time high of 250 gigawatts. The year-on-year increase in power demand is as high as 10.5%. The biggest positive is also that peak deficits have come down very, very sharply. So the difference between demand for power and power generation has come down very, very significantly over the years. And this, and this been the pace of improvement continues to be there even in Q1 F25. If you look at our, overall, monetary picture and fiscal picture for the economy, the GDP growth is likely to be at 7.2% in F25. Currency, we are using a working range of 82 to 85. This is not a forecast. This is the broad working range which we use to forecast our company's estimates, especially which are export-driven businesses. Interest rates, monetary policy is sensitive to emerging risks in terms of inflation, in terms of higher interest rates and their impact on growth. And monetary policy and RBI continue to monitor issues and actions taken by the global central banks before taking any decisions on our monetary policy. Fiscal deficit, as I mentioned, is predicted at 4.9% of GDP. There is a scope that this number could actually be better than 4.9%. Inflation, while we are in the middle of the monsoon, we could see some improvement in production of food grains and production of other food articles. So inflation could cool off as we progress in the financial year. So that right now RBI's estimate is at 4.5% for financial year ending March 25. Valuations continue to be above historical average valuation multiples, especially in the mid cap segment. Valuations are significantly higher than the historic average valuations. Market cap to GDP is above 100%. Indian corporate tax continue to be very, very stable. We believe that this is one of the large, sentimental factor which is positive for FIs, that for almost 5-6 years, corporate tax rate in India has been stable, irrespective of where fiscal deficit has been, irrespective of COVID kind of crisis. I think we've kept corporate tax rates constant. That also tells us that policy stability is very, very good, and this is likely to attract further improvement in FDI and FI investments. If you look at our corporate performance, these numbers are for financial ending March 23. FY24 numbers are still not yet out because a lot of companies are yet to share the annual reports for financial year ending March 24. So we see significant improvement in the ROE levels and also the leverage levels of corporate India, especially the top 1850 companies which report numbers. And we believe that deleveraging in many sectors is positive for ROEs and also for their operational flexibility in terms of handling rough periods and rough phases of business cycles. Market cap as a percentage of GDP has been trending higher, both because of the re-rating we've seen in stock markets in India, and also because of a lot of sectors which were historically not represented in equity markets coming and getting listed. And also the longer term trend of formalization and financialization actually, help companies capture larger and larger portions of the real GDP and real economic activity in their financials. And corporate profit also has been improving. If you see 4.4% of GDP, this number could see some further improvement in financial year ending March 25. And that's a number which we continue to monitor to see how corporate profits are improving in our portfolio companies. If you look at our portfolio currently, 78% is between secular and consumption, primarily domestic oriented businesses. And we've been structurally very, very positive on where domestic economy is trending, and which is where we've disproportionate 78% weightage to these two themes. Globally selective, companies in pharmaceuticals, and cyclical is one allocation we have in the agrochemical space. If you look at our sectoral allocation, the top 5 sectors is about 70%, which is mainly banking, pharma, FMCG, consumer durables, and telecom. Very, very focused set of allocation to 5 sectors at about 70%. Also tells you that we run a very high active share in our portfolio, that we don't invest in a plethora of sectors. We're very, very focused, compact, and have a large weightage to sectors where we have a positive view on. And similarly, top 10 companies in the portfolio, out of 20 companies in the portfolio, top 10 companies are about 60%. So it's a very, very concentrated and a focused portfolio of 20 companies, and fairly represented across mid, small, and large cap. And given that valuations are more favorable and risk reward is more favorable to moving some money from mid and small caps into large caps. We've seen weightage into large caps at about 54%. And the definition of large cap also keeps changing. So our percentage weightages also have to be viewed at keeping these things in perspective. So what are the themes we are positive on? Aspirational consumption, which is represented in our portfolio, consolidation across sectors, the structural growth in retail credit, selective and niche manufacturing exports, and infrastructure creation. These are the five themes which we are positive on. Some of the key portfolio constituents which we have in our portfolio across FMCG, automobile OEMs, banking, telecom services, companies which are in healthcare services like Medanta, companies which are in consumer electricals and consumer appliances like Havells and Prestige. Havells is also a participation in wires and cables that feeds into the infrastructure story. We have other companies like Elecon and Sumitomo also there in the portfolio. So if you look at our first quarter financial performance, the banking sector NII growth is at 10%. The pre-provisioning operating profit growth is at about 11%. PAT growth is about 7%. These numbers are also because of the fact that between Q4 F24 and Q1 F25, there has been a slight increase in costs of provisioning. That's why the PAT growth is lesser than the EBITDA growth. If you look at ex financials, which is our non-banking exposure in our portfolio, which is around 70% of the portfolio, revenue growth is at 12%, EBITDA growth is at 20%, PAT growth is at about 11%. If you see the flow through between EBITDA and PAT, there has been a degrowth because there are certain companies where there are large one-time forex adjustments. Otherwise, if you adjust for those, the PAT growth for ex financial is roughly 15-16%. At a portfolio level, 17% EBITDA growth and 10% PAT growth. Which are the companies which have done well among the 20 companies? Maruti, Varun, Havells, ICICI Bank, Sumitomo, and Divis have delivered very, very healthy EBITDA growth and bottom line growth. We believe that on a medium term, 3 to 6 years, there are structural growth prospects and drivers are intact to deliver healthy earnings growth. The earnings trends are representative of 18 out of the 20 companies in the portfolio. Our consensus estimates for our portfolio companies, the CAGR for earnings for F25 and F26 is around 17%. And as I said in my previous remarks, very intense heat conditions actually helped companies like Varun, Havells, because their products are mostly consumed in summer, like air conditioners and soft drinks are consumed in summer weather. At the same time, companies which are in say discretionary consumption, retail, companies which run hospitals. So there have been anecdotally and our interactions with portfolio companies and our interactions with other corporates in the sectors which we track tell us that there has been delay in construction activity, delay in travel and tourism, a delay in hospital admissions and elective surgeries, delay in retail footfalls in discretionary segments where you require people to go out and visit organized retail networks to generate and fulfill demand. There has been a slowdown there. And general elections, there has been generally delay in government finalization of orders. So that has led to some slowdown in this quarter. But we believe that as we go through the remaining part of the financial year, some of the pent-up demand in this quarter, because of the reasons I mentioned, should come back. Weather conditions have normalized now, and I think things should be coming back to normalcy in the remaining part of the current financial year. If you look at our portfolio return contribution, some of the companies like Varun, Bharti, Glenmark, and Nivami, these are the companies which are very early phase markets rewarded these companies. And some of the companies like Divis, Sumitomo, and Havells, their initial quarters, like our portfolio is about 18 months old. So in the first 2 quarters after we bought these stocks, the earnings growth and the other operational numbers were slightly below expectation. But as we went through the cycle of recovery, I think these companies have demonstrated very, very significant recovery in growth and profitability, and also the concerns on cheap products getting dumped in some of these categories, and impact of raw material prices on margins. Those things have all normalized now, and Havells also benefited from a very, very sharp improvement in the demand for air conditioners during this quarter and summer related products like air coolers and fans. So I think these companies have also been rewarded by the markets. And I think there is also a transient phase of stress in certain companies like HDFC Bank, APL, Apollo, and Century Ply. These companies are yet to be rewarded by the markets. Having said that, I think we constantly review our portfolios. If there is a requirement for us to make any course corrections, if we believe that there is a dilution of business fundamentals and there is a requirement for us to revisit the investment thesis, to assess the growth outlook, to have a relook at valuations, if there is lesser upside in our portfolio companies after re-rating, we revisit the investment thesis and take corresponding portfolio action. We also look at the competitive landscape wherever there is a evidence for us to believe that the competitive intensity has increased very, very sharply. We take corrective action in the portfolios, and also we wish to see that the underlying drivers for structural growth are always intact. So that's very, very important for us. So wherever we believe that there is a damage or dilution to these structural drivers for growth and value creation, we take corrective action at the portfolio level. If you look at the key changes in the portfolio over the last 18 months, we exited four stocks, which is Tata Consumer, PVR, Titan, and Bajaj Electricals. Tata Consumer, we made a switch into Emami because we believe that there was a greater scope for upside in Emami. So that was one switch which we did. PVR and Titan, we believe, there were certain reasons for us to exit these companies. PVR mainly because there was a long phase of stress in the industry. So we are yet to see signs of improvement in the industry. So we exited that. Titan is again another stock which got re-rated very, very sharply. So we took a call on exiting that and moved some of that money into Elecon Engineering, which is a participation in infrastructure and manufacturing story. And we also used some of the cash to increase our weightage to BFSI, which is private sector banks. And if you look at also some sectors where we have trimmed our weightages, either because there is an increase in single stock concentration, or because we believe that at certain level of valuations there is merit in reducing weightage to certain stocks. So because of that, we've also trimmed our weightages to these two names, which is Varun and Global Health. And what is the way forward? In this presentation, we have both our clients and also some of our advisors who help clients build their portfolios. Our view is that benchmark returns for the last 2 years have been significantly higher than the long-term trend line. So 2-year CAGR is at 23% versus 10-year CAGR of 13%. We've seen very, very sharp re-rating across many, many sectors in the last 2 years, mainly driven by expansion of valuation multiples. And we believe that it would be prudent to adopt a staggered approach to deployment given where valuations are and given where the global macro is positioned currently. And if you also look at where are the valuations and what is the implied growth based on these valuations, we believe based on empirical evidence that there is a possibility of future returns being moderated because of the current valuations. And we also anticipate slightly higher volatility in the markets over the next 12 months. We are seeing a very, very meaningfully concerning situation in terms of geopolitical risk. And also, if you look at the risk reward matrix, so we could see some volatility because we have seen a prolonged phase of low volatility in the markets. We believe also this is an opportune time for advisors to revisit the client's asset allocations. If your equity portion has ballooned significantly higher, it's time to prudently do some level of check in terms of where the asset allocation is. And if somebody is underinvested in equities, it's also an opportune time to relook at that. And also time to see if you have excessive concentration in a single style of investing, like a small cap or a mid cap or some manager concentration, where one manager has delivered very significant results. But given where markets are positioned, the returns may not be linear in nature. We could see a phase of volatility. And we also believe that Enam AMC, given its style of investing, given its flexi cap orientation, growth orientation, not saying that we are only focused on one segment of the market cap, we are a core component of the client's equity allocation. And our emphasis is always on persistence. When I say persistence, we mean returns over 5-10 years versus magnitude of what we've delivered in the last 1, 2, 3 months. And we've constantly reviewed the portfolio to see wherever if there are any reasons for us to make any course corrections, we've done that. So we believe that we are well positioned on a 5 to 10 year time frame. The portfolio is just 18 months old. So if the returns are generated in this portfolio, what you see today are only for a 18 months time frame. These are our returns. Since inception, we have done about 29% CAGR versus index of 33%. CY23, we did better than the markets. CY24 till date, we are slightly behind the markets. Markets about 22%. We are up about 14% as an end of July. And if you look at performance year in terms of financial years, in financial year ending March 24 till November 23, we had a healthy alpha. Post that, there was a sharp re-rating in the markets. Sectors which were not represented in our portfolio got re-rated, and I think we are continuing with that journey. And FY25 till date, market is up about 16.5%. We are up about 13.7%. So these are the portfolio returns for your reference. And what are the key risks which we see on the horizon? We believe that external economy, which is especially the developed economies, continue to be very weak in terms of the numbers they're representing. So that's a concern for export-driven businesses. Global interest rates could see some revision in the next 6 months. Also, post the rate hike by Bank of Japan, there is also a question mark on global liquidity flows. Inflation and commodity prices continue to resurface, whenever there is a geopolitical situation that could potentially lead to sharp spike in crude oil prices. So that's something which we need to watch out for. And political stability, we've highlighted this because after 10 years of non-coalition government, we are back to coalition government. So that's another factor which we need to keep watch out for. That's one of the risks which we want to highlight for our clients and advisors. Geopolitical risk, we have had situations in Ukraine and then in Middle East, Israel. Now we have a situation again on our borders. India is dealing with hot borders on both the sides of the country, and we are also watchful of any recurrence of healthcare crisis like COVID. And state government deficits continue to run high in cases of select states. So these are the key risks and some of the events which we wanted to highlight as key risks for our clients. And I'll probably now request Mohinder to open up our forum for Q&A. Thanks, Mohinder. Thank you.
Thank you, Raghavendra, for the update on the portfolio, your end. We do have some questions, and before we get into that, I request for everybody to put their questions as we start answering them in the chat box that's been opened up for you all to post across the questions that are there for us to. So the first question that I have is the Raghavendra, what's your outlook on the metal sector, especially some of the stocks like JSW and Nalco for investment medium term? That's the first question that you have.
Sure. We don't track companies in ferrous and non-ferrous metal sector. But broadly, I think if you look at last 1 year performance of certain commodities, till 3 months ago, non-ferrous did well. But now we again seeing a phase of consolidation in metal prices. As I said, global economy, especially the developed economies, are not demonstrating the kind of growth which would lead to higher commodity prices. And the supply side shocks which were there during Ukraine conflict have also kind of eased now. So commodity prices are cooling off as we speak. It's important for us to monitor commodity prices because aluminum, copper, zinc, and HR coil steel are major raw material components for some of our portfolio companies. And to that extent, we monitor these prices and when we interact with the portfolio companies and other companies which we track, we ask them about how they deal with these situations in terms of their capability to take price hikes. So to that extent, we believe currently neutral view on metal prices. No reason for us to be unduly concerned on very, very sharp increase in metal prices. Again, we don't track nor invest in metal stocks right now, companies which manufacture metals. So our view is primarily from the perspective that these are commodities which our portfolio companies use to manufacture and service their markets. Next question, Mohinder.
Thank you. One question is, are you suggesting to divert funds to debt instruments? One question that's come across to you.
Sure. So this is a pure equity portfolio. Any cash which we keep is only transient. We don't take any cash calls in the portfolio. So we would, by and large, try to be invested to the extent of 95-96%. So there is no reason for us to invest in debt. It's a pure equity portfolio. Your advisor will help you identify best investments in the fixed income side, and they are the right people to guide you on which fixed income investments are good for you. We don't do that.
Thank you. What's our house view on the interest rate cycle, and what kind of returns on the broader equity markets going forward investors can expect?
So currently, the short-term interest rates, especially the short end of the curve, which is anywhere between overnight to 180 days, is very healthy. The rates which are being offered on that tenor. And if you look at our 10-year GSEC is roughly around 6.9% now. So between overnight and 10-year, or 3 months and 10-year, there's hardly any gap in the interest. So the short end is interesting um, for investors who want to park their monies for shorter periods. There is no extra reward for you to take a longer term duration risk. The only reason why interest rates could be benefiting investors who take long term duration calls is if there is a rate cut, say in the next 6 to 9 months. So we believe that somewhere towards the end of this calendar year, if the inflation data, and if the growth data, and if the credit growth data are all conducive, and the global situation is conducive in terms of the actions taken by global central banks, we could see one or two rate cuts by our RBI. So that's our view on interest rates, and that's the assumption with which we are positioning our investments in banking and other rate sensitives. Next question, Mohinder.
Thank you. The portfolio has underperformed by 1,100 basis points in the last year, lagging the BSE 500. What are our learnings? And is it just a sharp rise in benchmark? Even the flexi cap mutual funds don't see have also lagged, or don't seem to have lagged so much at all. So what's our
Sure.
view on that?
Sure. No, definitely this is something which we are cognizant about, the index performance, which is why in one of the slides we highlighted that the last 2 year return from the benchmark on a CAGR basis is about 20 to 23%, whereas if you take longer term time frames of index return is around 12-13%. So we believe that the last 2 year return cycle has been very, very high, and some of the sectors which got re-rated, uh, we did not have adequate representation in those sectors because uh, they are not sectors which offer us long-term visibility of growth, and the structural drivers of growth. And some of the sectors which got related also don't have the factors which we look for, like cash flow conversion, the kind of governance which we look for in terms of having an identifiable promoter whom we can entrust your capital with. When we look at portfolio companies or potential companies for investments, we see who is the promoter, what is the pedigree, do we have an identifiable team which runs the company for the next 5, 10, 15 years? Because we think typically in blocks of 5, 10, 15 years. And which is where I think, some of our portfolio companies are positioned, and we missed out on some of the sectors, and we believe that on a long cycle of 5, 10, 15 years we should be able to deliver healthy alpha. Our team has a track record of delivering alpha over a 15-20 year time period. So we believe 18 months is a very short time frame to measure cross cycle performance of any style of investing. And our style of investing may not do very well if in certain cycles of market. And we believe that given earnings growth, where earnings growth is, and given where valuations are, and given where our portfolio is positioned, we have scope to outperform in the future. Next question, Mohinder.
Thank you. Given the comment on inflated PE and higher than normal market performance, especially in the last 12 months, what's the allocation approach for clients who are looking to add new funds on the
Sure.
existing portfolio?
Very, very good question. So in fact, in one of our slides, we did highlight that valuations currently are slightly higher than historical averages, and in some cases, significantly higher than historical averages, depending on which market cap we are talking about. So given the backdrop, we believe that it's better to stagger your investments. It's better to also keep maybe invest half of your money now and keep the remaining for a volatile phase in the market. And we also believe that it's prudent to stagger investments over a period of time. So that's what we've highlighted.
Sure. We suggested that the expected portfolio growth in FY 25-26 is say about 15%, which is very similar to, say, the Nifty EPS growth. If that is correct, then do you feel it will generate alpha, the portfolio, given that the valuations for the portfolio are more stretched than it is for the Nifty or mid cap index? That's a question.
Sure, sure. So the portfolio earnings growth and alpha are two very, very different things. Alpha, we are now, given where markets are and given investors' return expectations, people have started to measure alpha on a 1 month and 3 month basis. Whereas businesses might take 3, 4, 5 years to deliver the expected results. In terms of the earnings growth expectation, which I mentioned, is a consensus estimate, and we are at the beginning of F25. The number which we see for our portfolio companies on a CAGR basis between F25 and F26 is roughly 17%. We believe that these numbers have a significant upside risk, and whenever we believe that there is a reason for us to upgrade these numbers, we will do that. So as we see, 17% is a number which we are working with, and alpha is a function of if market is down 4% and if you are up 5%, alpha is 9%. So it's also a function of where markets will go on a 3 month, 6 month basis, on which we don't have any control. Our view is that over longer term time frame, if your earnings growth from the portfolio combined with your active share, combined with not doing the obvious mistakes of buying very, very expensive stocks at high valuations, if you take care of these 5, 6 prudent factors of stock selection and security weightages and security selection, I think we should be on track to deliver reasonably healthy amounts of alpha on a 5 to 10 year time frame. We are just 18 months into the portfolio journey, so we believe that we need to give it time for the portfolio to generate the desired results in terms of alpha.
Sure. Thank you. As we mentioned, large caps are better than mid and small caps. Will the allocations for large caps go up from the current stage?
Yeah. So if you see the changes we've done in our portfolio, we've exited some small caps or mid caps and moved it into large caps. And it's also a function of what kind of opportunities you see for either increasing the weightage in an existing portfolio, existing stock, or adding a new stock from any of the segments of the market cap. And at this point, we also want to reiterate that even if you buy a mid or small cap in our portfolio, we would always ensure that we don't buy into fragmented industries where there are 30, 40 commoditized players. Even if it is a mid or a small cap, we will ensure that we are in the top 3, 4 companies within that sector. Especially in the case of a mid or small cap, we would typically be with the top 1 or 2 companies in the sector. For example, if you look at the live cases of small caps in my portfolio, currently Century Ply is the largest company which operates in the wood finish or wooden products which are used in finishing of homes and other furniture. Similarly, if you look at large caps, we are present with the top 4 banks. In telecom, we are with Bharti. So you would try to identify the company which will be the biggest beneficiary of consolidation, biggest beneficiary of underlying structural drivers of demand growth. And even if you identify a mid or small cap, we would ensure that we are not overpaying for growth. So we'll keep those factors in mind when we are taking individual calls on companies. Our portfolio construction is also a function of where valuations are offering us the greatest deal of comfort vis-a-vis the kind of earnings volatility which we can see. So these are the factors which we keep in mind while identifying companies. We don't approach portfolio construction saying that let us have 80% large cap from tomorrow. That's not the way we approach things. We find the best portfolio companies based on risk reward, based on growth. And if that company happens to be a small cap, that's an outcome rather than a beginning point of portfolio construction. Next question, Mahindra.
Thank you. Given the fact that we've spoken about banks and that portfolio has a good amount of concentration, do you think that will be able to play out in the coming days?
Can you repeat the question, Mahindra? There was a call in between. I'm sorry. Can you repeat the question? Sorry.
Yeah, given our exposure to private banks, what's the outlook that we have and how our conviction is coming through in that basis in the coming days?
Sure.
Yeah.
Sure. Yeah, it's a pertinent question. Private sector banks and the entire banking sector is dealing with challenges in terms of deposit growth, challenges in terms of higher interest rates, which are being offered on deposits. So when you're raising resources, the cost you pay is very, very high. And it has become a challenge to increase the CASA side of the deposit book. Across the board, if you see the entire sector, raising of deposits through the fixed deposit route has grown much faster than the CASA side. So that's a challenge. And if you see on credit growth, currently there is no transient challenge or any challenge. There is no challenge on asset quality. Uh, we don't uh, we don't have to unduly worry about the last 3 month return from a private sector bank. I think these are long-term franchises which are built on very, very solid fundamentals, very, very solid track record of solid underwriting. They've built formidable business on the non-banking side, especially on asset management, insurance. So the banks which we hold in our portfolio are also owners of the largest life insurance, general insurance, asset management companies. So you also get a participation in the businesses which benefit from savings, which benefit from capital raise, which benefit from from the growth in the insurance. So we need to give them some more time for these stocks to actually see improvement in the returns from the stock prices. I think the underlying earnings growth for the last 2, 3 financials has been very healthy, and our outlook for the next 2 years is also remains to be healthy. What we've seen is during general elections, there have been certain concerns on, say, loan waivers or other forms of sending out certain social sector benefits to certain sections of society. So that tends to create certain concerns on capability to recover money. Barring that, I think we are on track to see healthy earnings growth from the sector, along with decent amount of risk management, healthy control on asset quality. So not a point of time for us to take a drastic call on banking. We continue to monitor if there is any source of durable pain in terms of asset quality or in terms of cost side challenges, which is why we constantly show the bounce rate data to you and other quantitative metrics to tell you that the industry continues to be in a reasonably healthy condition, and we don't see any major signs of structural pain in the sector right now. Next question, Mohinder.
Thank you. The switch to the Emami has done well for the portfolio. How have the more recent additions to the portfolio, like say Elicon or Pyramid, done?
Would say too early to comment. We buy any stock with a 3 to 5 year horizon. The only reason why we sell a stock before 3 to 5 years is either the stock got re-rated so well that we don't see many major upside in the next 2 to 3 years. That's when we say risk reward. And other reason is that our call would have gone wrong and we have a reason to believe that we should exit that stock. So let's give these two stocks their due course of time to deliver results, both in terms of operational numbers, earnings numbers, and also commensurate returns in the portfolio. Next question, Mahinda.
Thank you. Uh, our view on opportunities in IT and pharma sector.
We continue to believe that pharma is structurally well positioned to benefit growth from growth in the domestic pharmaceutical space, growth from improved pricing in some of the generic driven markets and branded formulation markets in exports, which is why we have a high allocation to pharmaceuticals. Most of the companies from the pharmaceutical sector this quarter, their growth numbers have been good. Divi's went through a rough phase in FY24, which is when we believe that it's a long-term sustainable growth franchise. Which is going through a temporary phase of pain in terms of lower growth compared to the historical growth rates. And Glenmark has done well, Divi's has done well. So we believe that there is a scope for our pharmaceutical sector exposure to continue to do well. In terms of IT, we continue to maintain the same view. We will re-examine our view if there is a reason for us to add something in the sector. We are monitoring the space, and our view, we've never had any allocation from the inception to IT in this portfolio, given the concerns on global growth and changes in the spending patterns of top IT clients. So we continue to monitor that space, and whenever we feel that there is a scope for us to add IT sector weightage to the portfolio, we'll go ahead and do that. Next
Thank
question,
you.
please.
Thank you. The consumption theme has not done well due to inflation, and as inflation reduces, it could benefit the fund slash portfolio.
So in fact, in our portfolio, consumption, encompasses actually your home appliances space, companies in auto OEM, which is consumer discretionary, companies which are in FMCG, which is Varun and Emami. So barring one or two companies, I think Varun has done well, Emami has done well, both in terms of operational numbers and also it has converted or translated into stock price performance. Uh, Broadly, what we believe that companies like Titan, they've run up very sharply, which is why we it's not that Titan has done very subpar performance in the recent quarters. We believe that valuation got related very sharply, very fast, so which is why we took a call. Otherwise, I think broadly, the concerns on consumer durable related performance continues to be there. Companies like TTK Prestige still continue to get impacted by slowdown in rural demand and slowdown in growth rates for consumer appliances space. But as we see summer pick up, as we see rural growth come back, as we see rural economy improve the narrative and improve the demand growth, the prospects for the consumer durable companies are likely to improve. Barring that, I think whether it is automobiles or telecom services or FMCG or other discretionary spaces, I think we've done reasonably well.
Thank you. Yeah, our opening comments appear to suggest a more cautious outlook for the markets in the next year. Is that correct? And given that the portfolio has more consumption and more large cap, do you feel that the portfolio would hold up better? It's a brilliant question.
Yeah, very good question. And we have been reiterating that the last 2 years, the returns from the markets, I'm repeating, last 2 years return from the markets are significantly higher than the trend line return for markets. When I say markets, for the BSE 500 index. So there is a reason for us to believe that it would be prudent to stagger our allocations. And we also examine how the overall market context is, and we periodically try to reposition and realign the portfolio without incurring too much of churn in the portfolio. We periodically try to realign the portfolio and reposition given the market context, given where valuations are. And yes, we do have about 56-57% large cap allocation currently, and large caps typically have lower earnings volatility compared to the mid or small cap. And we also try to ensure that even if I buy a mid or small cap, they are operationally and financially well positioned and well placed to deal with any challenges in the environment. And that's how the portfolio stock selection criterion works. And we believe that as and when the market tends to become volatile, we could see the outcomes in terms of what our portfolio alpha is compared to the market returns. But do take a 3 to 5 year call when you decide to invest with us. And we have a reason to believe that um, the last 2 years of slightly higher than trendline returns, we could see also 3 to 6 months of cool off in index going forward. So we are not unduly concerned. We are very upbeat about long term structural uh, growth for our economy, but valuations in certain pockets definitely look very frothy at this point of time. Next question, Mohinder.
Yeah, thank you, Raghavendra. Aligning to the same flow, what is the peg for the fund and the benchmark currently? The
For the
price
fund, I
earning.
think the definitely the P to growth would be higher than 1 because we don't purely go by price to earnings ratio. We look at multiple factors. What is the opportunity size? What is the profit pool of the industry? How does consolidation lead to higher earnings growth for the top two players in the industry? How can they accelerate their earnings growth by taking away revenue and profit share from the unorganized space? That's one of the factors which we look at. We look at the management quality. We look at the overall metrics in terms of return on investment capital and the difference between ROIC versus weighted average cost of capital. That's what we as shareholders earn when we invest in a company. if the ROIC is higher than the weighted average cost of capital, that's what shareholders make after investing in a company. We look at free cash flow conversion, we look at cash flow generation, we look at reinvestment rates, we look at return on reinvested capital. There are multiple factors which go into portfolio stock selection, the individual company analysis. So P is one of the metrics. It's not the only metric which we look at. So certain companies in our consumer space might have higher PE earnings multiple. At the same time, you have some of the largest banks in this country trading at less than 20 multiple. If you look at pure PE multiple, even the price to book multiples, some of the private sector banks are trading at much lower than historic average valuations. So we don't share the absolute PEG number for our portfolio, because P is not the only number we look at for our portfolio companies. We look at various valuation metrics, and PE multiple happens to be just one of them. Next question, Mohin.
Yeah, thank you. Coming to that, if the interest rates are lower globally, will it not help equities rather than be a risk as mentioned in the presentation?
We said this is a risk also because of the fact that when global central banks decide to cut rates, inflation for those economies has to come down in line with the targets of the central banks, and B, growth rates also have to cool off. Which is when they will be forced to cut rates. Right now, growth rates are not yet come down in line with what those central banks expect, and inflation continues to be higher than their expectation. Uh, and historically, the correlation is that when central banks cut rates, liquidity is positive. So that's one reason why market participants generally tend to believe that central banks cutting rates could be positive for India. But there is also situation of probably lower GDP growth, which is why those banks cut rates. And at the same time, while there are certain central banks cutting rates, there is a central bank of Bank of Japan which actually increased rates for the first time in many decades. So that could lead to actually spill over into factors like liquidity and global capital flows, which is what we've seen as a trigger for volatility in the last fortnight. That one central bank hiking rates, while other central banks are trying to cut rates, which is why we've highlighted this, and we believe that's a factor for us to monitor. And any delay in rate cuts also could be, a risk factor. So it's not just, interest rate cuts is a risk. Interest rates are a risk as a factor that they are so high today that our FDI flows got impacted, because if an investor is getting X amount of return in his own market, why would he go out and invest in another geographical market? So it's a multifaceted factor, interest rates, global interest rates. But we do want to highlight it as one of the risk factors, that if there is a delay in the rate cuts, or if instead of rate cuts, if you see rate hikes in say one global economy, it could be a risk factor. Next question, Mohinder.
Coming to that point itself, will the yen carry trades unwinding have any effects on the Indian markets? And have you observed any yen carry trade related funds investments into Indian ETFs? And just adding to that is, if you foresee another hike in rates by the Bank of Japan, and if that happens, do you think that will put selling pressure on the Indian markets, presenting an opportunity to enter, in fact? Thank you.
So any large volatility or any sharp drawdown in the markets is always a welcome opportunity for long-term investors. So we believe that if there is a volatility or correction because of any global factor, which doesn't have anything to do with the domestic economy, domestic consumption, domestic interest rates, or domestic investment sentiment, we should use it as an opportunity to increase or add allocations to equities. And in terms of the data on carry trade, yes, India, from the data which we have seen, India is a beneficiary of certain flows which come from investors who use carry trade as a strategy to invest in India. We don't want to comment upon future rate action taken by Bank of Japan. That would be, that's an hypothesis which we don't want to make at this point of time. Because those economies also, for example, if a country increases interest rates, and if there is an adverse impact on their export competitiveness, or capital flows or outflows from their economy, or abnormal volatility of their currency versus their trading partners, they would also take the call based on those factors. So we would not want to comment on what a particular central bank would do in the future. But we believe that any sharp corrections because of a particular central bank action should be used as an opportunity to invest in high quality portfolios for long term. And as I said, in our presentation, stagger investments, invest 50%, the remaining 50% can come in on a bad day. That's one of the strategies which can be used. Next question, Mohinder.
Adding up onto that, Raghavendra, the impact of the US election and Bangladesh, events on our markets, if any.
We did our numbers in terms of any revenue dependence on specific geography you're talking about. Uh, Nothing really significant as of now. There's no raw material dependence for our portfolio companies, nor end market dependence as a large disproportionate consuming market. So no specific observed impact of these developments. But it's a concern in terms of geopolitics because when you have hostile neighbors on both the sides, it creates that much challenge for our country in terms of ensuring that there is a decent amount of order on both the board on both sides of the country, and you can deal with one hostile neighbor on one side, but if you have a situation where on both the borders, if you have a coastal situation, it's a concern for the country. Next question, Mohinder.
Over the last 18 months, is there are stocks that we have analyzed and might have met the investment style that we regret not adding to the portfolio?
The only reason, we would probably re-examine what we've done is, see, we run a portfolio of 15 to 30 stocks. So that's a very focused portfolio compared to a lot of other investment vehicles which you might have been using. From a style reward perspective, I think markets have rewarded many sectors in the last 12 to 24 months. There is data to tell us that, very, very passively managed portfolios have also done reasonably well because market has been very broad based. I think the only hindsight based, everything based on hindsight, you have great deal of clarity when you look at hindsight because everything is crystal clear. Whereas when we take decisions on portfolios, we have to see three, four things. One is how does the company perform? How does the market reward the company? How does the macro evolve for the business in which the company is operating? So hindsight and making decisions on future, which is investment decisions, are two very, very different schools of investing in terms of, when you do hindsight analysis, it's more to do attribution, contribution analysis. And when you actually take portfolio decisions, it is based on our understanding or our view on what the company, industry, market, and the economy look like over the next 2, 3, 4, 5 years. Having said that, I think from a style perspective, I think if you go through a cycle of 5 years, you would be able to make a comment about whether our style has done well or not. 18 months, it's too short a time frame because you've not seen any cycle. You've only seen 18 months. It's a too short a time frame for us to say, do we have any decisions which we think we should not have taken. It's too short a time frame. But yes, there are one or two companies which we didn't think did well for us, and we exited those sectors, from the portfolio. Next question, Mohinder.
Thank you. Thank you. We take the last three questions out here. For the time across that we have out there on the webinar. What's the rationale behind holding Indigo Remedies or is the whole pharma sector which has done well is our perspective that we would like to have? If any red flags that we feel?
I think sector has done well. The company is dealing with certain US regulatory issues. We will monitor the situation, examine the news flow, examine the data coming out of those inspections which will happen during the course of the current financial year. And based on the outcome of those inspections, some of the companies' growth parameters could look better depending on the outcome of that inspection. Uh, but I think our understanding is that barring US market, the remaining markets performance is reasonable. Even in US markets where they don't require certain plants to supply products, I think they are doing reasonably well. And we refrain from making any company specific comments in terms of future forecasts on these calls because these are public calls. We would take any decision which we take, we will explain in the subsequent calls. But as we speak, we are reasonably optimistic about the long-term prospects. If there is any reason for us to change our view, we will definitely communicate that. Thank you.
Even though the current the top five sectors have about 70% of the portfolio parked into, do you think these are the sectors that will be in likely good state for the FY25, in terms of the earnings as well as in terms of the performance versus the benchmark?
I think, if you look at the fifth sector, which is in terms of the weightage, some sector which is sixth could become fifth, or something which is seventh could become fifth. So barring that, I don't think we are on a structural basis tomorrow saying that, okay, let us put some 15% in a new sector. I think these sectors will continue to be there. And whenever valuations go much beyond our comfort, or when fundamental performance is much below expectation, we will take corrective action. Barring those two scenarios, the weightages for some of the sectors will remain in line with where it is right now. We as a team and as an institution, we don't take any drastic calls about anything. We are more calibrated, conservative, long-term oriented managers who have seen cycles over the last 5, 10, 15, 20 years. And we have a demonstrated track record of almost 2 decades of delivering healthy amounts of alpha. And that's what we want to preserve and maintain. And the portfolio has delivered a CAGR of 29% since inception. And we believe that return is healthy, both in terms of an absolute number and also reflective of earnings growth from the underlying portfolio stocks, plus the benefit of overall re-rating of valuation multiples in certain names. So these are the 3, 4 parameters which we look at. We will not take any drastic steps of exiting some entire sector entirely on one fine day based on short-term constraints. If there is a long-term reason, that's only we will take an action. And long-term actions are not overnight; they're calibrated, measured, and very judiciously well thought out and executed. Thanks, Mohinder.
The last question, I'll take across, if we're given the projected volatility for the next 12 months, right, do we see changes to our Enam's top sector and the company allocations? If yes, what are they?
I think currently we are optimistic about the top few names which we own in the portfolio. I would repeat that if a stock is rewarding us much ahead of expectation, and if we believe that the upside is limited on a 2, 3 year basis and the risk reward is not in favor, we would either sometimes trim exposure, more to control single stock exposure, and more to reduce or restrict our exposure to certain kind of businesses, given where they are in terms of size and valuation. And if we find a very, very superior alternative to what we have in the portfolio, if I need some liquidity, then we would probably trim 2, 3 stocks and buy one stock, or sometimes exit one full stock and then add one full stock. Those are various ways we maneuver and realign portfolios. But to answer your question straight, I think we don't expect any major changes in the next few months.
And as I sign off for the webinar on behalf of Enam AMC, I'll just take this last question to answer that, Raghavendra. In fact, the question is that they wanted to know what's our recommendation between asset classes considering allocation valuation of equity, considering 5 years horizon period. So I think the question I think I would like to answer is that see, we're stock pickers at the end of the day, right? As a house, also, for the last 40 years that we have represented our institution, right, across various businesses that we have created. And today at the AMC, as we complete 27 years, right, we have been focused on creating consistently a long-term, wealth generation, and with a reasonable amount of alpha that we believe has come in because of that approach. Wish we could come in. I think every asset has its own play. Every asset has its own cycle, and its own valuation framework that it oscillates around, right? Today in equity, obviously, there is a good amount of participation that is coming through also for the fact that it's a participation that was long overdue, right? If you look at our entire savings basket, it is an asset class which has obviously a very high potential to deliver consistently high teen returns, and that it has over a period of time. But the allocation or the participation has also been very limited. If you look at our data at a national level as well as at a both individual level, right? When you see that, and that's the brilliant opportunity, that's the golden opportunity that we have, right? That while markets do give you the range of valuation to see over a period of time, over a shorter period of time, but over a long term, as you rightly put across 5 years, the probability of you being more on the right side than on the left side of the trade is in your favor. I think that's something as a house, we've been in one of our communication to our partners as well as families have been that we are perma bulls. We see an opportunity in our thought process that we exercise on a day-to-day basis, because that's what at a house level we have a understanding that we have developed, that what we have is something that has gone through a lot of litmus tests. And when we look at participating, we have a lot of cognizance to the way we manage the risk in the return journey that we create for our clients' portfolio. And that's how we are where we are today, with your support and the gratitude that I would like to express, that absolutely equity as an asset class does deserve a very solid, a very, very significant, place, in terms of its allocation, in terms of its weight. And I think let's not forget fundamentally, the nation is going through a very historic transformation, both politically, economically, and holistic manner, right? I think as we stand today, we just want to be there. I think as we say that it's about the not the timing, but about the time in the markets. I think the opportunity is possibly now as much as it's never been, for us to stay invested and in fact relook at our allocation towards this asset class, and take benefits on terms of the compounding that this asset class has always given, and I think it will still in the coming years have the higher range for us to participate and look through. That is the way I would look across at Enam, as always, and I think as my dear colleague Raghavendra has iterated out here on the call, we're focused while being on the macro, but more on the micro. I think that's the whole approach that we have out here, that we want to be absolutely sure of what we have, what and how we want to have it in our portfolios. That's the reason we have such a large team on the investment side, which is completely focused on understanding the not only the connect, but the network and also the numbers and the people behind those numbers. That's something at Enam we are very cognizant of the fact that where we are, we're absolutely sure of where we want to go along with them. That is purely because what we believe is market does evolve to earnings, and that's clearly it's a slave of those earnings. Obviously, it's not only about the intellect, but it's about the integrity of the people behind the story. And that's where there's a premium that you want to assign, and every asset and every style within that asset has its own play. We at Enam have always looked upon as being a very core equity, very classical oriented in terms of our nature of investing, the style. And we want to ensure that every 4 or 5 years, we should be able to compound it in a very healthy manner for you. And that's how our long-term track record has been and stead through the time for us. So that's where we stand across. We do have a couple of questions across out there, but I would request you to, that we would, get back to you on a P2P basis. The recording of this webinar will be uploaded on our YouTube channel, also on the Enam AMC YouTube channel, which will has the previous webinar recordings also being posted across for you to access it. And also we will be very happy. We do get a lot of questions, a lot of support from you all post the webinar. We wanted to keep it going. Please do write back to us. Please do connect with us and the team out here. We want to enhance our relationship and partnership, with the system that we are today working along. And as we, with the launch of Vision, has actually grown multifold for us. Thank you so much